All right, good morning and welcome back, everyone. And for those of you guys who just logged in right now, welcome to the PSC Investment Expo 2022. I'm your host, Danny Laurel. Now, what is this two-day event? It's an event packed with personal finance and investment related sessions. And in fact, we have a couple of very interesting presentations plus a panel discussion rather coming up in the next hour and a half. It's just been such a fruitful first hour, I have to say. For those of us who did miss the earlier opening sessions, it was very interesting. We had Jong Layog of Gcash talking about their platform and how you could actually use it to save and invest. We had Fami talking about personal finance. So really a lot of things to be digesting here as we go along, and you'll have the opportunity to look back on those sessions at your own time and on demand. Now, as you may know, I am with One News, and a part of what I do for the program is that I anchor the business news. This is called Business World Live. It's weekdays, and it is generally to cover our beloved stock market, particularly the Philippine Stock Exchange. And these days, I get asked two questions. First, what is happening in the stock market? There's a lot of uncertainty, there's a lot of volatility, but also a lot of excitement and opportunities there. And second, how is the stock market expected to perform this year? We wish we had a crystal ball, and if we did, we probably would not be here spending our weekends trying to understand how we can do better. But with the COVID-19 pandemic remaining a concern, and of course, you've got national elections as well coming up very shortly, there's a lot of questions on what might the outlook be. So I will be deferring to a very qualified fund manager to answer these questions for us today, here to give us a recap of the market's performance last year, as well as an outlook for 2022. We have with us Mr. Miguel Agarao. He's the Vice President of Philequity Management Incorporated. Now, Miguel crafts but also presents Philequity strategy as well as market outlooks to his clients and investors. So you guys are very lucky to have an expert with us today. Hi, Miguel. Very great to see you here finally. It's been a while since we, had our chats in the newsroom.
Yeah, good morning, Danny. I haven't seen you in person in a very long time.
I know. Well, I mean, this is the opportunity now to catch up, and we are all, of course, very excited to hear your talk on the market this year. I think this will be very challenging. People are going to be holding you to your words, once they do follow your advice. So the floor is all yours. Take it away, Miguel.
Okay, so good morning, everyone, and also special mention to PSC President Mon Monson. Thank you for inviting me to this expo. It's an honor to present to everyone. So Mr. C should be doing this, but I'm assigned to this. Anyway, so good morning, and let me just share my screen. So this is what I'm gonna do. For those who've seen the other Philequity presentations before, these are like 2 hours long, but no, I'm gonna do this in 20 minutes, okay? So that we can have more time for Q&A. So let me just share my screen, okay? Now this time, I dare say, is finally darkest before the dawn. There'll be 4 major factors that'll move the market. I mean, everyone's probably thinking of COVID, but I just want to highlight that I do not think COVID will be a major factor for the equity markets February onwards. It moved the market in 2020, it moved it in 2021. I don't think it's going to move it in a big way in the future. Now, for purposes of time, because of time constraints, I will focus primarily on 2 factors. So a bit of COVID, but more on interest rates. And this is, I think, one of the most important factors that will drive equity returns moving forward. So just a quick aside on COVID, NCR has peaked. The rest of the country should peak in February. I think I speak for most people here when I say majority of your social circles got COVID during this Omicron surge. And you see that really nearly all cases are asymptomatic to moderate. And the level of hospitalization and death this time is really very far from what you saw in previous surges. The only slight bad news here is that vaccination previously could prevent infection, but because Omicron pierces all forms of immunity, that the vaccination does really is prevent us from dying or getting hospitalized. Now, let's look at what's happening to our neighbors. There's a lot of hope. Now, South Africa, where theoretically it came from, look at that. It peaked and is now nearly going back to pre-surge levels. You see the same thing in UK. US has also peaked. Now, the important part is if you look at deaths, they are not rising in proportion to cases. So like people will be unproductive for like 2 to 3 weeks, and after that they'll be back to normal. Now, as far as the stock market is concerned, and I don't know if many of you have seen these slides, but these are slides I've shown in other older presentations. But for the benefit of the audience, I want to show you probably one of the three most important slides in my presentation, because as far as this Omicron surge is concerned, it peaks in 4 to 6 weeks. Okay, but in previous surges, Delta, South Africa, original variant, like what happened in markets. So in crafting the strategy of Philequity, in determining the timing of our investments, we look at history. And for this particular search, the most recent one was Delta. And then this is what I can show you, just to summarize. So this was a pretty long section before. So this is the timeline of India during the Delta surge. So what you see here is as the surge was going up, India's stock market actually lost 9%. But about 2 to 3 weeks in, okay, you see the market already stopped falling. So it lost 9% over 1 month, bottomed out there. 2.5 months later, the drop due to the COVID surge was all but erased. So that's the experience in India during the Delta surge. This blue line here are your daily cases, which are actually quite understated in India. But you'll see the market bottomed even before the surge peak. So somewhere even before the middle of your surge. You look at Indonesia, it did not have a sharp correction. Instead, it had a prolonged consolidation. The maximum drawdown was about 4%. But you'll see it hit bottom early into the surge and never retested that low or broke it ever. Then on the way down, eventually the market broke out. But you'll see it bottomed before the surge actually peaked. Now you'll see the same thing in the Philippines. Now we dropped 6%, and from that point, by the time cases had gone down, we had risen 10% from the Delta low. Again, what you will see here, by the time cases had peaked, we had erased the entire Delta drop. So what message can you take here? Markets bottom before an epidemic peaks. And historically, I know psychologically it's very hard to do this, okay? Especially if you know people who got sick. But historically, surges are an opportunity to buy. The only difference in Omicron is the correction wasn't large. Our market pulled back 3-4% only. So naturally, the rebound wasn't as strong either after. Plus, there are other contravening factors. But if there are surges, you're an opportunity to buy. And so, look at economic data. We'll go back to pre-COVID GDP, if not end of this year, by 1Q next year. I just want to highlight that this is going to be a fairly uneven recovery in GDP. But you'll see that your domestic consumption is offset really by your strong OFW remittances, which are very, very strong. 11-month official data last year is up 5.3% year on year. If you just do ratio and proportion on that, you're actually back to your pre-pandemic level of $33.5 billion, which tells you two things. Number one, the OFWs are sending back more of their savings, probably back here. But most importantly, they have jobs again. There is money to send back, which tells you the jobs they lost have all returned. Economies abroad have reopened maybe at a faster pace than we have domestically. So for OFWs, it's like back to normal or better already in aggregate terms as far as income is concerned. And that we can really see in the remittance figures. One thing I just want to be concerned about on the domestic consumption level are your brownouts. So NGCP did say there could be rotating brownouts in the summer, and if you have another unscheduled shutdown, you have a potential red alert. Now, typically we'll say, okay, this is bad for manufacturing, etc. But in this COVID era, this is particularly painful for work from home. You can imagine, like, I don't know if you see it on Twitter or on Facebook, where people complain their internet is slow, paano work nila, paano exam nila. Now imagine if there's no power, like if you have no generator, like how now, right? So this is a concern that this can have again a quite a significant impact. So let's hope that the power situation doesn't go into red alert mode in the summer. I hear water will be okay, so it looks like we're not gonna have a water shortage, but power is a concern. Now, just to show it like graphically in bar chart form. So this is the official data, 9-month GDP. You'll see that you only need like, because the fourth quarter was pretty strong, you only need like 6% to go back to your 2019 levels. So even if you're like only 5%, which is way below forecast, I mean, by 1Q23, you're already back there. But again, this is quite uneven. So I took one slide. This is from ADB. They had the presentation a couple of weeks ago. So they showed the GDP impact per sector. And you see that for like restaurants, transport, tourism, the impact of COVID has really been quite outsized. And you see things like government, IT bouncing back. Education has also bounced back as well. So especially I think in 2023, this is gonna bounce back big. Now inflation, if you think about it, from January to October last year, so 2021, I mean, we were still in the throes of COVID. People were still underemployed or unemployed. It was stubbornly high. Like you're like 4 plus 5%, right? So you have the double whammy of lost wages and higher food inflation. Unfortunately, November and December is going to go down. So I want to highlight that numerically, the spike in oil and natural gas prices this year only partially reflected in the numbers. So if that is sustained, your inflation this year is probably going to be a bit higher than it should be. And note that we are a net oil importing country, and not just oil, we also import a lot of things. So if the peso depreciates significantly, the peso weakness is going to contribute to inflation. So just something to think about. This is how inflation looks like. I mean, if this were a stock chart, maybe it's great if it goes all the way down here, but I don't know because oil looks like this. So the benchmark for the Philippines is Dubai crude. And what I want to highlight with Dubai crude is that, let's go back down memory lane. If you see this level, it's the same as this level in 2018 roughly. This was the level which prompted a pause in the implementation of fuel excise tax. And we are back above that, okay? I mean, it's a little bit higher than that now. So this tells you that oil prices are gonna be painful for our inflation figures and if sustained for consumption. So spikes are okay if they're temporary, but if it's sustained, that's a different matter. Now, the BSP thinks the inflation range is between 2 to 4%. Now, the numbers guy that I am, I try to check what the assumptions behind that are. And if you look at their assumption, they're looking about $72.70 per barrel average for Dubai crude. And they expect this 4% to be broken if Dubai crude reaches $95 per barrel. However, the current price of Dubai crude is 83.5, which is 15% above this. So oil really has to go down maybe around this level to like maybe 80, 75 to stay within this range. If it sustains the 80 plus level, we might overshoot the inflation figure, and mathematically, you might then undershoot your real GDP figure. Now, this is on the peso. Sayang yung chart na to for chart. This is a really strong move here, but it was reversed here. The peso ended up weakening 6.2% against the US dollar last year. Technicals indicate further weakness. Fortunately, the BSP was there, but I think without them, it might have weakened further. Fitch had the presentation also a couple of weeks ago, and their focus was the country's fiscal situation. So they said debt to GDP is likely to breach 60% in 2022. We think it'll be like 60 to 62. So 40% pre-COVID. The budget deficit is expected to narrow from 8 plus to sub 8. But note that in 2015 to 2019, which is pre-COVID, the average budget deficit was actually 2.4%. So you have two questions here. Number one, with businesses recovering, can your tax revenues actually catch up with higher interest expenses? And second, we borrowed buttloads of money to survive, this COVID era. So how long will it take to pare down debt incurred for those purposes. And so the next administration, whoever it will be, will inherit a mountain of debt. And I hope when whoever this president is elected, they're not like pure populists, because populist policies will only cause this to grow further. It went up like 4x over the past 20 years, 50% just over the past 2 years. So there have to be revenue generating measures to bring this down. Okay, and bring this down, that's like bring it down by 4 trillion, bring it down. So just to summarize the economic data part, we will likely exceed pre-COVID GDP levels in 2023. However, this is an uneven recovery, and the country saddled with mounting debt. Which brings us to rising interest rates. This is a very, very long section normally, but I'm gonna try to do this in briefly. So you have a post-COVID recovery, and then you have rising demand, which spiked. Hence, we see a big move in energy prices, oil and natural gas. In developed countries, you have what you call maximum employment already. So you take that all together, interest rates are finally set for liftoff. Now, if you look at the inflation in the US 40-year high, for those who are, who like reading about economic news, there was a debate between transitory inflation or persistent inflation, Larry Summers versus Paul Krugman and all that. Even the Fed felt that inflation would be transitory, but looks like it's not. So it's lasting longer than it should be. And if you look at EU, inflation is at its highest point since the EU came to be. So, and oil, this is not the Dubai crude anymore. These are global benchmarks. Above $80 per barrel, is probably 87 last night. So it's a double whammy. First, you had oil prices going negative for a while, but still very low for a couple of years, which really discouraged a lot of investment in additional oil supply and exploration. And these things take years. So because a lot of that was curtailed, then you now have like some sort of lack of new supply in oil. So the shale oil theoretically should have kicked in by now in the US, because they were the marginal producer that really tilted the supply-demand balance, hence the sharp drop in oil prices. But they have not started coming back in a big way. Then you combine that with very huge demand recovery, and then you have this move of oil going back to $90. You'll see in commodities also a different set of catalysts. Now nickel's at a 12-year high, not just on the economic recovery, but on electric vehicle demand. Same thing with copper. This is practically a record high over here, but just pulled back a bit. Look at gold. It's still kind of a fear inflation trade, but less correlation than before. I don't know if it's crypto or whatever. There are other options, but it's not moving the way it did like in previous years. If you look at agri-commodities, the good news is they're down like 20% or more from their recent highs. But if you compare it to where they were in the past 5 years, they're also up about 40% from where they were. So this inflation is gonna be painful for your consumers. You see for corn, wheat, soybean. Then you have US interest rates. So just graphically, after undoing the recent hiking cycle, interest rates are really set for liftoff. Which brings us to this. So typically a long discussion, but I'll summarize this. So what happens here is you can make a mathematical model on what the implied interest rate hike is based on bond prices are. And as of Tuesday, the numbers were very different from this. And come Thursday, after Powell's speech, where he said, you know what, we're gonna finish the tapering by March, and you'll start rolling over the balance sheet after that, and we could raise interest rates once per meeting. This totally changed. So previously, what markets were expecting were 3 hikes by November, with a 50% chance of a hike in December. Now, the market is like, no, you know what? You're having 4 rate hikes in November and a very high chance of a 5th one in December, which I doubt will probably happen, but it shows you that the market is forward-looking and is trying to price in higher interest rates in the future. So what is the Fed telegraphing versus what the market is expecting? That will help you understand why the market seems to be pricing in 5 rate hikes in 2022. It's because of this. So I just did it graphically because looking at the wall of text is not as appealing. So this is what you call the Fed dot plot. So what you can do here, after they have meetings, each Fed member votes on where they think interest rates should go. So one vote is one yellow dot. So in 2022, you'll see the vast majority of Fed members in the US think we should have 3 interest rate hikes. So this is where the market is coming from. However, if you look at 2023, if you look at the middle here, this could change. It could go here, it could go here, they could settle in the middle. These things will, change over the coming quarter. So let's see. But if I take the middle over here, what does this tell you? You have another 3 hikes in 2023, which means you have 6 rate hikes in the next 24 months. And the market, being a forward-looking creature, is pricing in that early. Even though they don't think it will actually happen, you see towards year end, they will start pricing in those additional 3 rate hikes for 2023. So that's what's happening on the bond market. And just as an aside, if bond yields are going up, okay, that means bond prices are going down. Now, in addition to rate hikes, many major central banks other than the Fed are also shrinking their balance sheets, England, New Zealand, Australia. So, I mean, except for China, most central banks are actually on a tightening path as well, which brings us to the Philippines. This is how our interest rate chart looks like. So, it begs the question here, if BSP Governor Jokno does not hike in the first half of 2021, how many times will he hike in the second half of 2022? So there's such a thing as an interest rate differential. So if the US hikes 3 times and we hike only 1 or 2, we'll be kind of behind them. And then the interest rate differential between the US and the Philippines will narrow, and that will work against the Philippine peso and may cause it to further depreciate. So all these things, as you can see, economically are interrelated. And if the peso depreciates too sharply, that will have a negative impact on your equities. At least historically, that's what happens if it's too big a depreciation. So this is something we have to watch in the coming quarters. Now, again, this is another long discussion, but I'll try to summarize it. So, some people are asking, do markets go down, up, sideways when interest rates are going up? So a long-term perspective should help. So this is the S&P 500 over the past 40 years, orange line, right-hand axis. The green line, left-hand axis is the our interest rates over 40 years. So I'll be done very quickly, last 5 minutes. So if you see here, use your sharp eyes, everyone. Interest rates are like going up over here, market does nothing. Early hiking cycle, market does nothing. Early hiking cycle, market does nothing. Early hiking cycle corrected a bit, very volatile. Early hiking cycle, very volatile consolidation. Early hiking cycle, volatile consolidation, sharp correction. So, and this one over here, 2013, Bernanke accidentally said QE tapering. So what does this tell you? In the early stage of a rate hike cycle, the market tends to consolidate or correct. And that lasts for about 3 to 4 quarters. But once the economy is on steady footing, if it is clear that growth can continue despite rising interest rates, the bull market resumes. Okay, now for the Philippines, there was no market here prior to the 90s. So we have a shorter timeline here. You only have like 30 years. So same chart, but the Philippines is in red. It is muddled by certain domestic events like political crisis over here, Asian financial crisis over there. So Yolanda over here. So over here, I mean Yolanda over there. So, but you see roughly the same relationship. When interest rates are going up over here, you see the market does nothing. Interest rates going up, market kind of moves sideways for a bit, slow up before moving that uptrend. Interest rates going up here, you see these major corrections over there. So again, same relationship, consolidation or correction early in the cycle, which by the way, we saw in the US in a very violent way, especially for tech stocks. And then once it's clear that growth is intact, the bull market continues. Now, not just a short bit on China, the PBOC is going the opposite direction. Now, why is this relevant? I won't go into the details except for this part. China is 30% of emerging markets, HK is 2%. Is HK part of China already? But kind of, right? So Philippines is 0.7%. Now, if you look at the Hang Seng, it moved up a lot when the easing news came out. So the question is, if China, which is 30% of the entire emerging markets complex, can recover as it eases, can it lift the entire emerging market complex, including the Philippines? So that's one potential catalyst, okay? Because China is so large, it's any move in China was going to affect the entire emerging markets index. So to summarize that portion, rising interest rates make navigating the investment landscape more difficult, but the bull market will continue if growth remains intact despite tightening monetary policy. So where does the stock market go from here? The Philippines was among the worst performing 2021. We're the third worst, but we're off to a good start in 22. We're like second best. The developed markets were probably up in 2021, but the US and developed markets are now lagging after leading the way last year. So, a lot of your tech stocks, which rose during COVID, they're getting obliterated in the past 5-6 weeks. Now, if you look at the Philippines, severe foreign selling. So this went on for like nearly 1.5 years, but finally in August, that trend broke. And what will you notice here? The foreign funds did not buy nearly as much as they sold, and yet our market was able to hold at the 7.2 level, go to 7.4. So they were still huge net sellers last year. So what does that tell you? Even a little bit of foreign buying. So just the foreign funds stop selling, yung market pwede na umakyat. But for a sustained recovery to happen, you need the foreign funds to buy. If I'll go back to 9,000, the foreign funds need to come back. Because if not, you look at it, that's where our market has been languishing for 5-6 years, is because the foreign funds have been selling our index down 5-6 years. Now, I'll just skip this part because we're running out of time. But the flavor of 2021 was really index inclusion plays, but those have since faded. Converge, Wilcon, Ascent. So I'll skip that. REITs. Okay, there was a fear this would sap market liquidity, but instead it broadened the investor base. So there are a new set of investors who kind of want to dip their feet into equity investing. So this is kind of like a bond for them, but it's actually an equity. So if they want to shift out of this and buy common shares, they can do it readily because they're already on the board. So it's a very easy process already. So the REITs turned out to be very, very good for the market and yield-seeking investors. Now I just want to show this. Why is this relevant? You'll notice something here, okay? This August 2. The market was up 2.8%, huge. It was at 6,446. You'll notice here the traded value was only 3.3 billion pesos. And I want to impart one lesson here. The typical market volume is 7 to 7.5 billion. This is less than half. As this interest in the market peaked, Philippine stocks bottomed. So you see here for the chart is out there. This was August 2. The Philippines had the double bottom here. Cost 7,000 to be broken with the vengeance. Initial target of 7.4 was already reached. Now on technicals, the long-term target is about 7.7 to 8,200. So that's your next major resistance. We'll break that eventually, especially because a lot of stocks are still very cheap. There are also very significant buybacks in 2021. We expect these to continue this year. From all the different, from the Ayalas, Angutan, Gokong Ways, MVP Group, Ricky Razon, FPH. So this tells you three things. Now, one, the owners believe that the companies are undervalued. Otherwise, why would they be buying back their own shares? Second, owners are confident that earnings will also grow significantly post-COVID. But it also tells you a third thing. It means that the owners believe that this is a more ROE accretive option than embarking on additional capex. So this gives an indication of what how their capex will look like this year versus 2021. Now, this is a weighted average earnings growth for all the PSAI components according to our research. So this is per component. The average is about 20%. I will dispense with sector analysis. This takes another 30 minutes or so. Fast. Okay, wait. Okay, and there. Fair value of the PSEI is 8,010. So that's 19.7 times 2022 PE. That is not a demanding number. We've hit 23 times PE before. The way we arrive at this target is basically we get the individual targets for each index component. So that's what our research does. So some are price to book, some are PE, some are discount to NAV, some are DCF. You take all that, multiply it by your PSEI weight, then we get this target. But for simplicity, the PE for all that is 19.7 times in aggregate. So to summarize, okay, markets bottom before an epidemic peaks, surges are an opportunity to buy. Now, vaccines, please get your vaccines. That's the way out of the pandemic until you have a really great cure. The sharp rise in energy prices is a global risk, but much more so for the Philippines. The tightening cycle, meaning rising interest rates, is a short-term negative for equities in general, especially EM assets if their currencies depreciate. If economies can show growth despite rising interest rates, the bull market will continue. Now, foreign funds have reduced their Philippine holdings significantly. And as I said, kaya naman ng locals to keep the market afloat. But if you want to go back to record highs, you really need that foreign participation to come back. Now, the focus has shifted away from index inclusion plays to reopening plays and index heavyweight. So it's really back to fundamentals. And finally, the PSEI is still trading below its 5-year average PE. So upside, not just on earnings growth, but also on valuation. And remember, the owners are on your side. If they're buying, why don't you buy too? So before I end my presentation, I just want to remind everyone to please visit our virtual booth at the exhibit hall. People can talk to you, can learn about Philequity, can invest in our funds. So there will be people there to assist you. This is a really nice and noble setup by the PSE team. Congratulations, guys. This is like metaverse levels or something. So thank you, and stay safe, everyone, and enjoy the rest of this PSE Expo.
Thank you so much, Miguel. I mean, very, very interesting discussion there. And I hope you can give everyone a copy. How do we get a copy of this presentation? But I really did appreciate some very specific things that you mentioned here. COVID will not be, I might have to quote you on this, COVID will not be a major market mover from February onwards. Markets
yes, you can quote me.
Before an endemic peaks, bottom out before it peaks, the OFWs have money to send back, so it's back to normal already in terms of remittances. We will likely exceed pre-COVID GDP by 2023. Ano pa ba? The rate hikes, of course, is still a risk factor here in terms of what the PSP will be doing. It's going to be keeping in step, or will we be behind the curve there? Peso still a key risk there. Thank you, Miguel. Very interesting discussion.